Right now, in Toronto and across British Columbia, two different groups of people are walking into the offices of licensed insolvency trustees and filing for bankruptcy. The first group is developers, companies that borrowed hundreds of millions of dollars to build condo towers, ran out of runway, and can no longer pay their lenders back. In BC alone, close to $500 million in condo development debt went into default in a single 12-month period. Projects that were 95% finished, buildings that were basically done, ended up in the hands of court-appointed receivers. The second group is regular people, condo owners, people who bought a unit, thought they were building wealth, and woke up to find their mortgage is now worth more than their home. Personal finance expert Doug Hoyes told CP24 he's watching it happen in real time. People whose mortgage renewal is coming up and whose monthly payment is about to jump by $1,000 a month. And if they try to sell to get out from under it, they can't, because the bank won't release the mortgage unless they get every dollar back that they're owed, which means some of these owners are left with one option: personal bankruptcy. A CP24 report from last year put it plainly. Condo sales in Toronto are down more than 30% over the past year. Average prices have dropped 13% annually. And the Bank of Canada warned that if trade pressures persist, the financial stress on Canadian households could exceed what was seen during the 2008 financial crisis. This is not one story. It's happening on both sides of the country, to thousands of people, right now. Let's break down exactly what's going on and what it means depending on where you stand.
Here's the simplest way to understand what happened in Toronto. Between 2020 and 2022, developers were selling pre-construction condos at peak prices, units that wouldn't be finished for 3 or 4 years. Buyers locked in, deposits were paid, agreements were signed. Then everything on the cost side exploded. Construction costs in Toronto jumped roughly 80% between 2018 and 2023, according to Statistics Canada. Labor got more expensive, materials got more expensive, and Toronto's development charges, the fee the city collects per unit before a single shovel hits the ground, reached $141,000 per unit by 2024. That's just the government fee, not the land, not the concrete, not the workers. So developers sold units at 2022 prices and now have to build them at 2025 costs. For smaller developers especially, that gap became impossible to close, and the buyers they were counting on to fund construction through new pre-sales stopped coming. With nobody buying, developers couldn't cover their loan payments. Banks went to court, receivers took over. The most talked about example is The One, an 85-story luxury tower at Yonge and Bloor in downtown Toronto. In October 2023, a South Korean lender called KEB Hana Bank went to court after the project defaulted on over $1.2 billion in loans. Total debt on the project sat at $1.6 billion. According to court documents, the developer owed interest at a rate of 21.5% annually because of a default clause, meaning the debt was growing faster than they could build. Then, in May 2025, a historic church on Bathurst Street, the Randolph Theatre, was ordered into receivership. The developer owed $23.5 million to its lender and had missed payments since May 2024. They tried to sell the project to another developer. Nobody stepped up. The people who already bought units there are now left waiting. And in November 2025, a near-completed 31-story building on Yonge Street, the Ellie Condos, was placed into receivership with $185 million owing. The building was almost done. The condo declaration had already been registered, and it still went under. According to Build, total new home inventory in the GTA right now sits at 20,557 units, representing 26 months of supply at the current pace of sales, the highest ever recorded. Developers are sitting on product they cannot move. This is where it hits real people hardest, so stay with me. When you buy pre-construction, you sign a contract at today's price for something being built over the next 3 to 5 years. You pay a deposit, often $80,000 to $150,000, and you wait. When closing day arrives, your bank sends an appraiser to confirm the unit's current value. But condo prices in Toronto have dropped 9.8% in the last year alone, according to January 2026 TREB data. The average condo is now selling for $604,759. So if you agreed to pay $750,000 3 years ago and it appraises at $620,000 today, the bank will only mortgage you the lower number. You have to bring the $130,000 difference in cash at closing. If you can't, the developer keeps your deposit, and in some cases, they can sue you for their further losses on top of that. A man named Vitor Almeida told CBC News this is exactly the situation he's facing. The developer told him directly they'll sell the unit for less on the open market and come after him for the difference. He told CBC, "They're telling me they're going to sell it for less and they're going to come after me for their losses." He's not alone. This is playing out across thousands of closings in the GTA right now. And here's what makes it worse. If a project goes into receivership, buyers don't automatically get deposits back. Toronto real estate lawyer Mark Morris told the Globe and Mail, the insolvency of the builder does not qualify for the return of the deposits. Carry-on insurance covers deposits, but only up to $20,000. Most people put down far more than that. If you're finding this useful, hit subscribe. We cover the Canadian housing market every week with real numbers, no speculation.
Now let's talk about British Columbia, because what happened there in 2024 and 2025 was some of the most dramatic developer fallout this country has seen in a single cycle. The name everyone knows is Thind Properties, a Burnaby-based developer who had built his company from the ground up over decades. By late 2024, he had accumulated close to $500 million in mortgage debt with a single lender, KingSett Mortgage Corporation. In November 2024, a 1,023-unit development near Surrey Central SkyTrain, called District Northwest, went into receivership after a default on an $80 million mortgage. 2 more Thind projects followed within weeks, High Line in Burnaby and Minoru Square in Richmond. Then in January 2025, the Eclipse Tower in Burnaby, 335 units, 95% built, 224 of them already pre-sold, was placed into creditor protection. According to court filings, the company owed $190 million to KingSett alone, and that debt was growing at $54,000 every single day. Think about what that means for the people who bought in that building. A nearly finished tower, deposits paid, move-in date planned, and suddenly there's a receiver running the show. The fallout hit everyone around it, too. A real estate agent filed a lawsuit claiming $800,000 in unpaid commissions. A drywall company said they were owed $1.7 million. A crane operator went to small claims court over $17,000. That's what a developer collapse looks like on the ground. It's not just investors. It's tradespeople who showed up to work every day and didn't get paid. And Thind wasn't the only one. A planned 55-story tower in Vancouver's West End went into receivership after BMO said developers owed $82.2 million. The original investors reportedly lost around $80 million on that deal. In July 2025, Curve, a 60-story tower that was being marketed as the world's tallest passive house building, went into receivership after Brivia Group defaulted on a $90 million loan from RBC and BMO. Tony Quatrin from CBRE summed it up as clearly as anyone has. We've never seen this many receiverships in one cycle. So let's talk practically, because that's what matters. If you're a renter right now, the short-term picture has actually softened. Toronto's average rent dropped 7.1% to $2,632 per month as of December 2024. More units on the market means more options and less pressure on you. But this won't last. Construction starts fell 51% in 1 year across the GTA. The pipeline of new units being built today is nearly empty. When that catches up with the market in 3 to 5 years, rents will likely climb again, hard. If you're an investor sitting on a condo unit, you're in a tough spot. Average condo prices are down nearly 10% year over year. Active listings are still elevated. Selling is the obvious move, but you're competing with a lot of other people trying to do the same thing. TD Economics noted that a significant share of Toronto condo investors were already losing money every month before this latest drop.
If you're a first-time buyer, and TRREB says 45% of people planning to buy in 2026 fall into this group, the math has genuinely shifted your way. Prices are lower, inventory is high, and sellers need you. Nobody can promise you this is the absolute bottom, but it's a very different market than it was in 2022. And if you already bought pre-construction and your closing date is coming up, talk to a real estate lawyer before that date, not the week of. The gap between what you agreed to pay and today's appraised value could be significant. You need to know your options ahead of time. Here's the big picture. Toronto and BC built their entire new housing supply model on condo presales. Developers needed buyers to fund construction. Investors needed appreciation to make returns work. The whole system depended on prices going up, rates staying low, and costs staying manageable. All three of those things broke at once. The receiverships will keep coming. More closings will be painful, and the construction slowdown happening right now means a housing shortage that will likely be worse than anything we've seen a few years from now when this works its way through. Ordinary Canadians who made what seemed like a reasonable bet on real estate are now stuck in the middle of all of it, and no one saw it unraveling this fast.